Here with this week's hottest stories in the investment world, this is Zach's Friday Finish Line.
Hello, and welcome to a special edition of the Zach's Friday Finish Line.
Today, we're going to be speaking with Will Rhind, a recognized commodities expert and former CEO of the largest commodities fund in the world.
Recently, Will founded his own ETF company, GraniteShares, and currently serves as the company's CEO.
GraniteShares claims to be a new kind of ETF company with a focus on disruption through new exposures, better structures, and low-cost investments.
The company offers two broad-based commodity ETFs, COMB and COMG, as well as a brand new gold-focused fund, BAR.
We were able to talk to Will about these funds, as well as the latest trends in the global commodities industry and what investors interested in this space need to know right now. Check it out.
Okay, thanks for joining us, Will. We wanted to start things off today with a few questions geared towards the investor with little experience in commodities or those that are really just starting to invest in the space. So when you think about the commodities market, you quickly realize that we're actually talking about several distinct industries, including energy, precious metals, and agriculture. So all of these industries obviously have their own influences and risks, but is there a common denominator or a grand unifier that helps us think about commodities as one investment strategy?
Yes, there are. It's a great question. And I'd say that there are really three things that sort of tie commodities as an asset class together. And those are one, the US dollar, two, inflation, and three, diversification. So let's start first of all with the US dollar. And typically what we see from some investors is using an investment in commodities as a hedge against the dollar. And typically what that means is that if the US dollar is declining in value, it makes commodities, which are priced in dollars for the most part, less expensive for other investors or buyers and consumers around the world who are not on the dollar, and therefore help stimulate demand for commodities. Perhaps away from that, the two most common ones we see in investor portfolios today are hedging against inflation and also diversifying investments within a portfolio. So starting with inflation, typically if you look at the makeup of what the market considers to be inflation, be it the consumer price index or a similar measure, typically you have inputs such as energy and food that make up a large percentage of that particular index. And so commodities being, for the most part, energy and food, or certainly some of the major sectors, can provide a hedge against inflation. And then lastly, diversification. In a portfolio context, commodity prices tend to move in a different direction to equities and bonds. And people say that that is a low correlation to the equity and the bond market. So therefore, you could have a scenario where if the equity market, the bond market is falling, commodity markets may be rising, and vice versa. And so people like to own commodities as part of a diversified portfolio because they have different risk-return characteristics and have a low correlation to equities and bonds.
So in a similar vein, I want to touch on commodities in the contemporary world. A lot of the things you mentioned in things like the price of oil, gold, and corn, these have been bedrock economic indicators for decades and decades. But how have we seen the way these goods are traded change as investing has become dominated by institutional buying and algorithmic trading?
I think like most asset classes, commodities haven't been immune to technological change. So a lot of what we used to call open outcry trading of commodities, i.e. being done for the most part by human beings in a center like the Chicago Board of Trade, over time, that's all moved electronically traded now. And so you have large liquid markets that are really traded on an electronic basis and almost now really available 24 hours a day around the world for trading. So like a lot of the other asset classes, commodities are no different. The markets have been moved to more electronic-based trading and have become sort of more liquid and efficient, sort of largely as a consequence.
So I know you created a new gold-focused fund to kind of switch gears just a little bit, but besides ETFs, investors have other options to invest in gold, from buying gold stocks to purchasing physical gold. So is an ETF a safer or better option to invest in gold over other methods?
It's a different option. And what I mean by that is there are, as you rightly pointed out, distinct or different ways to achieve something similar. It may not be the same, but something similar. First of all, let's take gold stocks or gold companies and gold. That's just a fundamentally different investment. Back in the day, before gold ETFs, buying gold mining companies was really probably the most common or popular way that people tried to get exposure to gold. But a lot of those people weren't looking to get exposure to the company. They were looking to get exposure to the price of gold, but they couldn't do that because there wasn't a viable way to invest in gold. And so what gold ETFs have allowed people to do is just invest directly in the price of gold and take out the risks associated with running a operating company like a mining business or other types of commodity producers. And what that leaves you is the ability to express a direct view on the price of gold. So investing in a gold company that doesn't track the price of gold, that is an altogether different investment. I think when it comes to gold coins, again, that's a different investment. Yes, of course, it's gold, but gold coins are minted by governments and different issues of coins, typically 1 ounce coins. And through the process, they trade at a significant premium to the price of gold. So what I often say to people is gold coins are certainly an incredibly valid and popular way to invest in gold, but really that's more for sort of commemorative or other type value to really have in your home. And if you want to have a more kind of institutional investment on gold, or a way to invest efficiently in the price of gold, really the only way to do that is with an ETF like our gold ETF bar.
Interesting. And we will get back to your specific ETFs here in a little bit. I do want to shift our focus kind of to the very current day. We're currently operating in a really interesting macroeconomic environment. And as I'm sure you know, investors are expecting one more interest rate hike from the Fed by the end of the year. However, the central bank appears to be relatively confused about our low inflation rate right now. So how has this environment affected the commodities market? And what is your outlook for the commodities space if we do get another rate hike in December?
So in terms of the outlook, I think any kind of shorter term things like, a potential rate hike in December, for the most part, is already baked into the price of either gold or the commodity market more broadly. And that's obviously largely being telegraphed by the Federal Reserve. And so it tends to be baked into markets, and it's typically only surprises that affect the kind of short-term view for commodities. But longer term, what's really now starting to drive commodity prices, and particularly this year, is the falling or weakening of the US dollar. So as you know, the dollar's been very strong for the last few years. And this year, 2017, we've really seen this sort of downward trend in the dollar since the beginning of the year. And falling dollar, all things being equal, is typically helpful or positive for commodity prices, and in particular gold, because gold tends to be inversely correlated with the dollar. And so that's the kind of the dollar view on commodities. But I think more broadly, we're seeing a pickup in demand, because really for the first time since the financial crisis, we seem to have the beginnings of what looks like a coordinated global rise in global GDP for the first time. And, that, all things being equal, creates, more demand. And that's more demand for energy, more demand for resources, more demand for commodities. Now, we also have a growing population that right now the world, net increase, the world population increases by about 80 million people a year, which is a country the size of Germany, roughly. And so all those people need to consume, will consume commodities. So I think, in terms of the immediate term, we have some tailwind now for the first time in a number of years for commodities, which is a weakening US dollar and stronger demand. And I think the interest rate scenario, be it another hike by the end of the year, won't really affect prices, because really what's driving commodities is a combination of demand and a lower dollar.
So, stemming from that, another kind of elephant in the room here is the current political environment here in the United States. One thing that's really taken over our conversations with the stock market is the GOP's proposed tax plan, as a so-called Trump rally has been fueled by the anticipation of corporate tax reform. Has the commodities market been affected by this chatter, or really any of the other political turmoil we've seen over the past few months?
I'd say that probably the broader commodity market, not really. However, I do think you could make an argument that gold has been affected by it. And I think that's probably manifested itself in a couple of ways. First of all, kind of getting back to the dollar. And the dollar is kind of so important because it's linked to so many of these factors. And so whether you talk about a stimulus, for example, by way of tax cuts, so any kind of tax cut, fiscal stimulus at this late stage in the cycle, that could be inflationary, which could be beneficial to commodity prices, and again would seemingly indicate a weaker dollar. Then you have the sort of geopolitical tensions over North Korea, for example, which certainly have made people think about that situation and how that could affect, and again, some kind of shock like that. Typically, people look to gold as a hedge against any kind of crisis. So it's probably those two things in the main, and then I guess the broader conversation that come up, albeit more at the sort of debate stage at the moment about global trade, any kind of trade tariff or other kind of import tariffs, etc. One would think in the long term would not be positive for the dollar, which then it goes back to being positive for gold, particularly, and maybe other commodities as well.
Thank you for that insight. We have just one last question we wanted to shift here. We wanted to take this opportunity as we wrap things up to talk about specific investment opportunities that our listeners have right now. We noticed that GraniteShares seems very open about considering itself a new type of ETF company that offers an original product. Can you describe the structure of your ETFs and touch on what is unique about them?
Yeah, I'd be happy to. So really, why we set up our business and why we exist as a company is to solve two major challenges for investors. The first one in the commodity space is high investment management fees and just high costs more broadly. The cost of commodity investing within the ETF space has been disproportionately large relative to equities and fixed income. So that's something that we want to solve for investors. The second thing is what I refer to as suboptimal products. And what I mean by that is the structures that maybe investors are not completely familiar with. So funds that are structured as partnerships that distribute K1s, which can cause investors a lot of headaches around tax filing time. And then also notes or exchange-traded notes, ETNs issued by banks, which are not funds, and a lot of investors don't realize have credit risk of the particular issuing bank. So what we try to do is really reinvent the commodity ETF by offering funds that were structured or are structured as 40 Act vehicles. So that's the same wrapper as your equity and bond ETF. They don't issue K1s. They're not notes, or don't have credit risk like ETN, and have industry low management fees. So hopefully that's a fairly straightforward proposition. I think certainly something was lacking on the commodity side, and we just want to offer investors a better investor experience at a lower cost.
We want to thank Will for joining us, and if you want to hear more about his products, please go to www.graniteshares.com.
That does it for this special edition of the Zacks Friday Finish Line. As a reminder, if you would like us to cover a different story, email us at podcast@zacks.com and check out all of our other exclusive audio content at zacks.com/podcast. Thanks again for joining us, and we will see you next time on the Zacks Friday Finish Line.